Verizon Communications Inc. ticker symbol VZ is currently trading at $45 a share. This is a favorite for dividend investors with a dividend yield of 6.02%. That is an absolutely massive amount. On top of that, this stock has been on an absolute tear from the start of the year, up almost 34%, which if we compare to the S&P 500 over that same time, it has easily beaten the market with 34% compared to the market's 26.8. So a massive dividend payer and currently beating the market over the last year. Is this the right time to buy Verizon? What we're going to be doing is looking at my automated stock valuation spreadsheet, looking at the company's financials, then looking at my discounted free cash flow model, the comparable company model, the dividend discount model, and of course the Ben Graham formula for intrinsic value to see if Verizon is a buy or a sell. Now, yes, as I said, this stock over the last year is up 34%, year to date 15%, but over the last 5 years it is down from highs of $61, dropped almost 50%, and has rebounded up about 45% since that bottom. So it kind of continued those previous amounts. That's what we're going to try and look at today. So if I go to my automated stock valuation spreadsheet, if I put the ticker VZ in here, what it'll do is it will load all the latest company financial data and we can go a little bit deeper. So as I said, $45 a share, market cap of 190 billion, PE ratio of 16.87, meaning that this is much lower than the market average, which is currently at around about 29. So that is looking good. Earnings per share, $2.67, and a beta of 0.42, meaning it should be a lot less volatile than the market. Analysts currently saying it is actually not a buy. $41.18 is the target price. Now, dividend. This is a massive point, a reason why people like this stock. 6.1%, which nets investors around about $2.75 a share. That means they're currently paying around about 11.6 billion in their dividend, which is actually higher if we look at the net income payout ratio of 102%. But in terms of free cash flow payout, it is under 100%, 82%. So sort of verging on the unsafe side, which is quite interesting to see. Ex-dividend date not marked here, but if you buy your shares before the 10th of October, you will be able to... Oh, actually, I've got the link here. I'm forgetting I've added all this stuff in. If I go to dividendmax.com and type in ticker VZ, you can see that if we don't have the information here, you can see that ex-dividend date is the 10th of October and you'll be paid on the 1st of November, which would be excellent. So let's have a quick look at the revenue numbers here. Revenue currently 134.24 billion. Revenue has been steadily increasing, but overall stable, down from its all-time highs in 2022, but trailing 12 months is looking pretty good. Net income, what are they doing with that revenue? Well, you can see profit is down slightly, 11.25 billion. It dropped off massively in 2022 and is currently at that 11 billion mark. Free cash flow, they had bad in 2021 with a big negative, and they managed to build back up that free cash flow to just shy of 14 billion. Shares outstanding, what are they doing? Well, you can see actually they have been issuing slightly more shares over and over the time. Now, if we look at the chart again and go over those 5 years, when they were issuing shares in 20 and 21 at about $50 a share, this was pretty good because the stock price dropped to 30. So ideally, you would like to see them to start buying back, which would suggest that they think that the stock is undervalued. Assets versus liabilities. Liabilities are very, very high. Assets are low, but that has been consistent with Verizon the entire time. Okay, so let's have a look at my discounted free cash flow model. This is a way of valuing the company based on estimates of its future free cash flows and discounting them to today's value. $53 based on averages. So let's have a deeper look at the numbers here and see if we agree. Well, one thing that's jumping out at me actually here is the free cash flow numbers are quite low. So we'll increase the... Let's take averages of these numbers here, ignoring 2023. Average is about actually around about 100%. We'll go 80. That brings the free cash flow. Let's drop it down a bit more. Actually, let's drop it down to 50. You can see that brings the free cash flow closer to this number. That puts it an $84 stock. Revenue are analysts thinking that this is still growing? Let's see what they suggest over the next 5 years. Positive growth of about 0.82%, and they are expecting revenues to be in the region of 135 and 137, which is pretty close to what we've got in terms of the revenue growth rate. And net income margins, they have been decreasing. Let's go on the more bearish side. Actually brings us down, interestingly, to a $54 stock as well. So it is actually a buy, which is good to see. But with these sort of lower free cash flow ratios, you can see why the discounted free cash flow model likes the stock. We'll quickly look at the dividend discount model. Based on the sort of increasing yearly dividends with a growth of around about 1.97%, I think that's pretty good. And a discount rate, the weighted average cost of capital is currently around about 5%. And if we put it there, it does put it at a $91 stock. Normally the discount rate is somewhere in the region of 7 to 7.5. That puts it at about a $50 stock. So dividend discount model does like the stock. We'll look at the Ben Graham formula for intrinsic value. This is a way of valuing stocks by the grandfather of value investing, Ben Graham. Looks at the earnings per share. It also looks at the growth rate, the AAA bond, and the current yield of the corporate bonds. Current yield of the corporate bonds is around about 4.8%. Yep, 4.87. And we know, actually, we know the growth is only about 1%. That puts it at a $22 stock. For Ben Graham to like the stock, it would probably have to have an expected growth rate around about 12%. So that's on the high side. So Ben Graham does not like the stock. Finally, I want to look at the comparable company model. This is a way of valuing companies, looking at similar companies with similar businesses and enterprise values or market caps, and looking at certain metrics like EV to revenue, EV to EBITDA, PE, and we also look at some other things here: net income, profit margins, PEG, which is Peter Lynch's formula. One that jumps out at me immediately is not ticker, god damn you, Google autocomplete, is T, which is AT&T. Another one is T-Mobile, which I believe is ticker TMUS. Oops, I can't type. Now, I only have this on my second one. I don't have all the charts here. But if we look, you can see that ignoring Amazon, they're all been trending in a pretty upwards direction. So this compares T-Mobile and Verizon very directly. Enterprise value, all pretty similar. Revenue, Verizon is the highest. 5-year growth rate, pretty flat, whereas AT&T is down and T-Mobile is up. EBITDA is 48 billion to 42 and 30. Net income, T surprisingly the most profitable. They have the with 12.7. Verizon 11.3 and T-Mobile under 10. Profit margins all about the same. Verizon actually has the lowest with 8.3%. Price to sales and price to book. You want the number lower, and Verizon is in the middle. PEG, interestingly enough, T-Mobile USA is the lowest. Peter Lynch would like this. Under 1 normally means it is a buy. We've got EV to revenue, EV to EBITDA, and P. As you can see, it is kind of lower than all of those, and that puts it at around about a $60 stock, which would say it is a buy. So this is quite a favorite for investors. 6% dividend, and discounting free cash flow and comparable company is saying it is a buy. Right, guys, thanks for watching. Please give a like if you enjoyed the video. Check my Patreon if you're interested in the spreadsheet, and I'll catch you guys next time.